Good afternoon, everyone. This is Professor York. I'm going to do two quick videos. They are going to cover, in part one will be the market sizing, and then the second part that I will cover as a separate video will be on competition. Market sizing will focus in on various strategies as well as a little background information that will help out, I think, in terms of understanding some definitions and maybe even some sources or resources to go to. So I think to start with, I want to just underlie market descriptions so that at least you're aware of some terminology in terms of how we segment markets and ultimately get to our target market. So market description can be basically a description of a market based on the need that the product fulfills. Sometimes it can be overly narrow. And this could be not to the benefit of companies. So you need to really think about defining your market clearly. And the way we break it down can be the potential market, which is all people in the population with interest in your product or service. Available market, which is people with interest plus means or money, and then qualified are those who are legally allowed to purchase the product or service, or served market. I'm going to expand on this a little bit and give you a little bit more of what we use over at Innovation Core, which we use the concepts of TAM, which is total addressable market, SAM, which is serviceable addressable market, and SOM, which is serviceable obtainable market. And SAM is really this whole large universe. So if we look in the transportation sector, what you see is it's all types of transportation. But good marketers realize that they cannot just address everyone. And this is a common pitfall that we do run into with a lot of startups. Serviceable available market get into those two other segments that we previously discussed about in terms of those who have means, those who are legally qualified. Okay, we're honing in on that. And what we're looking for, clear future use growth in a market that predicts that presents with a rapid and predictable growth that one can serve. E.g., in this case, we went from transportation down to automobiles, and particularly luxury automobiles. The obtainable market is the one that you're going to target into ultimately, and where you're going to play. And that could be, for instance, here, these sports cars that are there. So this is very useful in terms of framework, in terms of targeting, but also in terms of then using this focus to be able to develop your market sizing models. So where do you get your data? So there are analyst reports. They are expensive, but they're very in-depth. In fact, I was looking at one this morning that was $1,000. Some go up to $5,000. Or you can commission report, which can cost up to $15,000. And here are just a few of the firms that focus in on the B2C space. Also, is you can look at the literature. You can do internet searches, get teaser data from report, they call them report highlights or sample reports. The business press, Fortune, Wired, New York Times, Wall Street Journal, will have descriptions of markets. Trade associations are a wonderful source. Low-cost membership, but you can get high-quality articles. And I think for the value for the dollar, this is probably one of the best places. For a few $100s, you may be able to get data that may have cost you a few $1,000s. And then blogs and social media are also useful sources that are there. Some folks will go far as saying that Facebook could be used as well as a source for market sizing. So there are two ways we can do market size. One is top down, one is bottom up. The top down looks at the population, and in this case, as you see at the top, the general U.S. population in sort of a wide whole swath. And you could look at even sub-markets here in terms of virtual reality, looking at, really very high level, which you get from secondary data. And then you can see also the personalized medicine. And this is where you can get from market reports that are there. Sometimes you need to drill down on this, but this is, your high level data. But realistically, effective top-down market research in terms of describing your market involves what we call a chain ratio approach, or basically multiplication of various factors that get us down from that TAM ultimately to our SOM. And here's an example, for instance, looking at the dental floss market. So the first area is you look at the population, which we take from the census, okay, and that is 308 million people in the U.S. based in 2010. But then we get some data from the American Dental Association, which talk about the percentage of Americans who floss, which is 12%. You can have to get additional data in terms of number of uses per year, which is 365, and you actually can get from again, ADA and other sources relative to use of dental floss down to the level of the amount per day, which is 1 foot. Not in my case, I think I use a little bit more than that, but the price for that 1 foot, which is 3 cents. And then last but not least is, since this is a product that we're trying to hone in on who are concerned about eco-friendly products, you find that market research shows 2%. So by multiplying these different factors or drivers, which are points 2 through 6, you can then come to really sizing the eco-friendly dental floss market at $8.1 million per year. Another top-down example is one that we used over at Berkeley just recently when we were looking at the video streaming market for Disney Plus. And as you can see, as you look at on the left-hand side, the factors that we took to pull together and multiply this chain ratio, we were able to take population value in terms of households, okay, which came from actually Nielsen, okay, and then we talked about age, which were particularly in target markets of Gen Z and millennials in terms of percentage. Then we looked at watching behavior, again, data that came from Nielsen. And then we went and got data from Disney reports relative to the price of Disney Plus. And then we looked at the frequency per year that the individuals would be using, since that price is on a monthly price. A multiplication of that factors give a sense of the size of the opportunity, which was almost $4.9 billion. And this sort of just breaks down our TAM, SAM, SOM in terms of not just dollars, but actually number of households that were there. So this is a very good example of doing a top-down. Bottom-up is the opposite strategy in terms of, and is actually felt to be a little bit more accurate strategy, where you start to cobble together various subsegments to be able to characterize the market that's there in terms of total, in this case, especially with very, very targeted businesses, such as tunnel boring machines, which are used for creating tunnels for transportation. So you could see subsegments of municipalities, major construction companies, and international sales of being the 3 major subsegments that are there. You could also add up channels of different types of customers, especially if we have niche products such as Ferrari dealerships. And from there you can be able to pull together or aggregate the market from the bottom up. And I think that's at the bottom line, is that niche markets tend to work very well with bottom up, although I've been able to use bottom up techniques with prevalence and incidence data, as well as market use data with certain pharmaceuticals, to give me sort of a feel for what the market and various indications are for certain types of drugs. The niche market that we need to keep in mind is identification of relevant organizations, determine the quantity of those relevant organizations, and then multiply the quantity by the price to get the market size. So those are the sort of the stepwise process that you should be thinking about. So here's an example. We're looking at these are PET-CT scanning machines. These are very expensive. They're $3 million each. They tend to be in very, very sophisticated medical centers. So it's very much of a niche product. From there, we have identified that sophisticated medical centers tend to be with larger number of hospital beds, over 500. And then based on American Hospital Association data, we can be able to identify that 5% of the hospitals in the U.S. are over 500 beds, which translates out to from the 5,795 hospitals out to 290 hospitals. That's your target market. And then what you can do is multiply that quantity by the price, and that would give us then a working number for a target market. You can also look at other channels such as urgent care, and then you can be able to repeat this process in terms of the number of urgent care centers that would qualify, and that can give you a second niche then to fulfill in. Here's a Disney Plus example, and this is what our team ended up doing is we segmented different types of streamers that were using video streaming and identified numbers of individuals. We then ended up looking at the percentage of viewers that belonged into our target market, which were millennials and Gen Zs. And by multiplying those factors, we were able to get in terms of total subscription potential that would be there for each of those segments, which then roll up to being the combined market size in terms of 55.6 million subscribers, which translates at $6.99 a month of $4.66 billion. So that's another way of being able to characterize that market. And at the end of the day is you're going to pull, when you do a market size, you're going to pull from different sources. Some are going to be published, as you sort of, as in our first example. Some will be that you will calculate from the top down to your target market. And the third would be from a bottom up. And you put different weights based on the quality of your data. So based on that, we're using the Disney Plus example again, is that 30% were top down, 40% was based on secondary research that was published, and 30% was bottom up, which translated out to, with that weighted average of the three different techniques, to give us a much more accurate figure of $4.68 billion, which is a pretty attractive market. And usually what you're looking for when you're doing market size is this market large enough for us to enter into or someone to invest into? And that's one of the first questions that an entrepreneur needs to answer for his investors. And last but not least, tied to that question about is it attractive enough, especially if you have smaller markets, is whether the individual market is growing, especially if it's small. With large markets, the growth rates are going to be much smaller, but with smaller markets, what you look for are double-digit growth rates. And we do this by using what we call compounded annual growth rates in terms of specific market segments. And so what you do is you look at maybe over 2 years at least, and you look at least 3 to 5 years, and you get the starting value, which you put on bottom here, and then you put the file that you divide into the final value, which is on the top. You then raise it to 1 over the n, and the n is the number of periods. So if we look at, in this case, you have multiple periods you add in there, and that then becomes a factor that you would then calculate out, and then subtracting 1, because the final number always comes 1 point something. And what you need to do is by subtracting out 1, it gives you actually the growth rate that's there. So this is a valuable tool to really identify, is the market flat, declining, growing? Is it growing single digits? That might be okay with very large markets. Double digits, especially with younger, less mature markets. Anyway, that's the first video I want to leave with you to refer back to. I'm going to come back with a discussion on competition. Hopefully this will help you out as you prepare for your final presentation and your research.